Cathie Wood's ARK Innovation ETF is roaring back up in 2025, up more than 70% from its April lows. It's one of the biggest comeback stories in the market. But here's the real question. Do you just buy ARK and hope for the best? Or can you actually take what makes ARK special and use it to find the next Tesla, the next Tempus AI, or the next robotics giant before it explodes? That's what we're doing today in the Elite Trade Club. We're not just looking at ARK, we're reverse engineering it. I'm going to show you how to build your own stock screening strategy, what I'm calling the ARKK 2.0 approach, so you can start spotting tomorrow's disruptive innovators right now. Before we build our own version, we need to understand what makes ARK tick. ARK Invest is built on one big belief. Disruptive innovation is where the next trillion-dollar opportunities will come from. They break that idea down into 5 main areas. 1. Genomic revolution. Everything from DNA sequencing to precision medicine. 2. Automation. Robotics, warehouse systems, autonomous machines. 3. Energy transformation. Clean energy, EVs, new power storage. 4. Artificial intelligence. The tech that powers everything from chatbots to self-driving cars. And 5. Next generation internet. Blockchain, cloud computing, and decentralized finance. Now, here's what ARKK 2.0 really means. It's not about copying their holdings. It's about copying their logic, their process. Instead of following, you become a curator. You pick out companies that fit the disruptive playbook before they get big enough for Cathie Wood to buy them. And why now? Well, ARK's recent rally didn't happen in a vacuum. A pause in tariff wars calmed markets. Inflation data improved. And on the technical side, we got that bullish golden cross where the 50-day moving average crossed above the 200-day. Combine those, and suddenly disruptive growth is back on the table. That's why this moment is perfect for building your own ARKK 2.0 portfolio. Here's where things get fun. We're going to turn the ARK philosophy into an actual stock screener. If you've never used one, think of it like a giant filter. There are thousands of stocks out there. The screener lets us narrow them down until only the most promising candidates are left. If you're new to screening, most free tools like FinViz, MarketWatch, or TradingView let you plug these metrics in directly. For deeper analysis, platforms like Seeking Alpha or Simply Wall Street can visualize margin trends and R&D spending over time. You don't need to be a quant, just know which levers matter most. Here's the ARKK 2.0 criteria we'll use. Imagine this as a table on screen. 1. High revenue growth. Rationale. ARK doesn't go for sleepy companies. They want early-stage exponential growers. Example filter, revenue growth above 20% annually. 2. Strong and expanding gross margins. Rationale? It's not just about growth. You need pricing power and scalability. High margins mean a moat. Filter, gross margins greater than 40% and improving. 3. Significant R&D investment. Rationale? Real innovators spend aggressively on research. It's their lifeblood. Filter, R&D growth above 10% annually for the last 3 years. 4. Focused on disruptive themes. Rationale. You want to stay inside ARK's hunting grounds. AI, robotics, genomics, blockchain, automation, cloud. Filter. Limit by industry and sector. 5. Optional. Market cap filter. Rationale. While ARK often holds large caps like Tesla, the next big winner usually starts smaller. Filter, market cap under $20 billion. With these filters in place, you'll instantly cut through the noise and spotlight only the companies with both explosive potential and the DNA of innovation. Bonus tip, you can save these filters and rerun them every quarter. That's exactly how professionals track emerging leaders, by spotting who's accelerating, not just who's already big. Okay, theory is nice, but let's make this real. You can plug these filters into free screeners like FinViz or Yahoo Finance. So what kind of names pop up? Here are a few examples to show you the logic in action. AI and robotics. Symbiotic. They're reinventing warehouse automation. Or Terranide, a leader in collaborative robots that can work side by side with humans. Genomics and AI. Tempus AI is a textbook example. They're blending artificial intelligence with precision medicine, using data to personalize treatments. Not only is it disruptive, it's already caught the eye of ARK itself. Industrial automation. Rockwell Automation. They might not sound flashy, but they're powering the digitalization of factories worldwide. It's the backbone of automation, and without it, a lot of innovation stalls. And remember, innovation rotates. In 2021, it was EVs. In 2023, it was AI. In 2025, the spotlight could shift to robotics, precision health, or edge computing. The ARKK 2.0 method isn't about predicting which theme wins. It's about always being positioned where disruption is gaining traction. This is the power of the ARKK 2.0 screener. It doesn't just show you hype stocks, it points you toward businesses with the fundamentals and focus to be genuine disruptors. So how do you actually put this to work? I like to think in terms of a core satellite portfolio. Your core could be something stable, like an S&P 500 ETF or a broad total market fund. That's the foundation. Then you build your satellite with maybe 5 to 10 high conviction stocks you've screened with the ARKK 2.0 method. This satellite could make up, say, 20% of your portfolio. It gives you that upside potential without risking everything. And just like ARKK, you'll want to actively check in on these companies. Every quarter, ask, are they still growing revenues? Are margins expanding? Is R&D strong? If the answers slip, maybe it's time to rotate. Now, let's be clear. Disruptive investing comes with serious risks. First, volatility. ARKK itself has a 5-year beta of 2.15, which means it's more than twice as volatile as the market. These stocks swing hard. Second, concentration risk. If you only pick a handful of innovators, you could get hit if one flops. That's why diversification within your satellite is key. Mix AI with genomics, automation, and blockchain plays. Third, the innovation life cycle. Not every disruptor makes it. Plenty burn cash and fade. Your winners need to be big enough to cover the losers. Also, timing matters. Disruptive tech tends to outperform early in recovery cycles, but lag when interest rates rise or liquidity tightens. Keep an eye on macro trends like bond yields and Fed policy. They can make or break growth-heavy portfolios. The goal isn't to time perfectly, but to stay aware of the climate you're investing in. That's just the reality of this game. So let's recap. The ARKK 2.0 strategy isn't about copying a fund. It's about adopting a process looking for high revenue growth, strong margins, and heavy R&D in transformative industries like AI, robotics, and genomics. This is how you move from being a passive investor to someone who actively curates the future. And now I want to hear from you. Which disruptive theme excites you the most for 2025? AI, robotics, or genomics? Drop your thoughts in the comments. And hey, if you found this breakdown useful, hit that like button and subscribe to Elite Trade Club for more strategies to upgrade your investing process. Thanks for watching.